Welcome to FX Options University. Join the industry's top trading professionals.
Everybody knows about the credit bubble in China. A lot of people say it's not a bubble. Other people say it's a massive bubble ready to break at any moment. Either way, there's a lot of pressure on China to rebalance its economy. They have a very powerful beggar-thy-neighbor export policy, which all of Asia generally does, by suppressing their currency. They don't have much of a domestic market. The domestic market is growing and growing fast, but the relative size of the domestic market just can't take the massive amount of final goods that China produces, and that's the problem. We need a stronger dollar to try and start really some rebalancing here in China. It really does it would help to take the pressure off of China and have them start to look the other way. There's a lot of implications to this, and as Steve knows, we've done a complete webinar on this whole interrelationship between China and the U.S. and its currency policy and its current account, and I'll get to some of that. But this is really the situation in the world that at the moment, besides the Eurozone imploding, providing global systemic risk, this China-U.S. relationship, as we know, is critical in the world. China is the growing dominant power out there that's pulling the world along. We're starting to see a little bit of slowdown in China. But what we're also seeing is China still digging in its heels on the currency, even though it's said it's going to cut its peg to the dollar. They're not going to let the currency run much at all, and it's going to be very, very slowly. They're also getting tighter and tighter on U.S. businesses. You may have seen the flap with the German industrialists I think just this morning. It hit the papers, or yesterday, excuse me. That's a big deal. So there's some real pressures growing against China about their policy forcing Western companies to basically hand over all their technology and the like. And in a world where global demand is declining and China needs all the cooperation from the West that they can to push those final good exports out, here's an area that still we think is a major, major risk factor in the world. A rising U.S. dollar here will tend to take the pressure off of China and reduce that bubble in a big way. And if you think of it from the standpoint, a rising U.S. dollar on a relative basis empowers the U.S. consumer and increases his purchasing power, which is something China needs in a big way because the U.S. consumer is still the big buyer of China's exports, and they need the U.S. consumer to be in the game. And this is where it kind of all interrelates in here, that all of these things kind of self-reinforce, especially the real economy improvement and getting money into the real economy and small businesses, creating jobs. And also creating some consumer demand or keeping consumer demand alive goes a long way to rebalancing this China situation. And the fourth factor was U.S. capital investment. The improvement in the U.S. current account, which we'll get to in a minute, is a function to a degree of a lot of U.S. savings, or I should say paying those that have the ability to save. But either way, a lot of the consumers aren't spending the money they did before, whether they're saving or paying down debt, private deleveraging the world. If this continues, we're going to have a pool of private capital out there that's going to tend to denute some of this lack of money flow back into the U.S. if that were to be the case. But the flip side of this is also, if you look at the U.S. and the real economy starts to gen up and the U.S. dollar starts to move in the right direction, you'd have a view that the U.S. Assets look very, very cheap from a foreign investor given what's happened to the U.S. dollar over the last 7 years. So you'd see, again, that self-reinforcing process of very cheap assets with a rising currency. It would tend to bring international money in to get positioned for the currency to continue to rise, buy in cheap assets, and again, tend to reinforce that process. So all of this is kind of a self-reinforcing circle in these four major macro themes, and that's why we've laid it out that way. As I said, some may be in trouble. And these are the five we refer to as the five thematic rationales here to support those four big global macro themes. Number one, we're seeing an improvement in the current account deficit, and I have slides for each one of these, so I'll go through this quickly and talk more about it when we get to the slides. Mr. Triffin phone your office. This just refers to this idea of Triffin's dilemma, and I won't go into this too much, but Triffin was an economist back in the 50s, and he said once the U.S. dollar becomes the world reserve currency, it can't avoid running wide current account deficits because it has to lubricate the globe with its currency instead of gold. Number two, improving yield differential. We expected the Fed, again, looking back at this point here, we expected a hike in interest rates, or at least taking some of this money away, so we could try and, in an effort to force some of that money into the real economy. We haven't seen that, and here's a part of our story that may be breaking down a little, but it isn't over yet. So improving yield differential in the U.S. dollar, meaning the Fed would hike faster than Europe and Japan. It's still in play, but again, the yield differentials for the U.S. dollar are actually going a bit negative again, but we'll talk about that. Foreign direct investment, just talked about that a bit, just asset purchases on the cheap, and just gross fixed investment in the U.S. fallen dramatically since the credit crunch. We think that rebuild with a rising dollar is self-reinforcing, and we talked about a bit. Risk, the world reserve currency really tends to do well on risk, and the world reserve currency, by the nature of it being the world reserve currency, it has the deepest capital markets in the world, and that's why it does so well on risk. People run to the treasury markets to hide big deep capital, and the dollar gets a risk bid in spite of whatever's going on in the U.S. That's a factor that's always been supported for the world reserve currency, and especially continues to be in this environment, especially with the concern going on in the Eurozone. The valuation squeeze. This goes to again a little bit about what's going on in Europe. They need a lower currency. In effect, the two major trading competitors for Germany are the U.S. and China. The U.S. and the Chinese currency tending to move hand in hand, and I think the world needs a lower euro, even if it doesn't implode. I think in general, most people would agree a lower euro is going to tend to provide a little relief for the zone, and this is what this valuation squeeze refers to. So let me get to the current account. Just want to make a couple of points on the current account, and the current account's a tough thing to use to trade on, and I don't think it's anything you can use with any relevant time frame as a trading indicator, but it does give you an idea of just global macro things going on in the world, and I think from those we can we can have a lot of takeaway from it if we keep an eye on the current account. Just want to show you an example of this type of analysis. This black line is the U.S. current account deficit, and as you can see, here's zero, and everything else here is negative on this is a quarterly basis, and just showing the first time we started to see the current account start to deteriorate in the 80s, going negative in here, and then we had something called the U.S. stock market crash, 1987. Those of you that may have been around or maybe remember that. It was later followed by a recession in the U.S., kind of the key to triggering a recession in 1990. We also saw at the same time the popping of the Japanese bubble, and this was the beginning, actually, right in here in 1990, of a 10-year bull market in the U.S. dollar. It changed the dynamics in a big way for the dollar in that Japan was kind of taken out of the picture and capital was flowing back to the U.S. again. Plus the bear market we had in the U.S. dollar prior to that made the U.S. assets relatively cheap. But this big risk bid that, again, we saw in the dollar, triggered by this improvement in the current account deficit, was a big driver. Now, this improvement in the current account deficit, the reason it impacted Japan so much, there are a couple reasons. Number one, whenever we see an improvement in the current account deficit, think of it as dollar-based credit coming out of the world. Remember what we said, when the dollar took over the position of the world reserve currency and took over gold's role, the dollar has to be that liquidity tool. So whenever the current account deficit deteriorates, it means there's more dollar credit in the world. And whenever it improves, this line going up, it means there's dollar credit coming out of the world. That can come from either just money and deleveraging, or it can come from consumers that aren't buying as much anymore, that are getting scared and taking. And when that happens, those countries that are tied so closely and tightly to exports and the U.S. consumer that demand that dollar credit and demand that purchasing of their goods, when we see an improvement, it often is coincided with a major conflagration, in global markets, and this is an example right here.
Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.